Welcome to Think Property Club's Think Tank, where we connect, share, and learn the tips and hacks from our specialists. They become part of our A team, supporting us to create the best developments in the property game.
Welcome to the webinar today. My name's Jason John Byron. I'm here with Derek Wong, and we're going to talk about finance, doing anything from a house to townhouses to duplexes, all those type of things that are involved. I want Derek to start off by telling us about where he is and what his history is and how he got into what he's doing and what his future plans are. And then also, as he goes through the review with us about where we're up to at the moment, and tell us some stories about some deals that he's financed recently for people. And then I also want Derek to tell us a bit about how he's worked with us. So what I always tell people is I would prefer if you use a broker that has done the type of deals that you want to do, or at least done many of them for other people. So the first difference between a lot of brokers is some brokers are very good at just buying helping you buy a house, or maybe even refinance your house. But I find it very far in between the brokers that have actually done construction as well. And that's a big step, because first off, you're buying the property and then you're actually getting another loan to take over to do the construction sometimes too. I think the most important thing that I can drop in there also, and Derek can give me some feedback on this, is that a good broker has a good relationship with the BDMs of the banks and the other financial institutions. And that's really what it's all about, that relationship that they have to know the people behind the finance as well. And that's why you actually need to be in this for a long amount of time, because how are you going to build those relationships? You need to have the stories that that person has had before with previous financing where they've got stuff through. So they also know which banks will do certain things, which banks will do other things. And then also, the beauty of someone that has done a lot of finance in this game is that they can look over everything that you're paying now and give you an honest account of whether you should refinance or not. And refinancing isn't just about getting a lower interest rate. It can be about structuring you into your next deal with better terms. And that's one thing that I see a lot of people make mistakes on, where they're just trying to go after the lowest interest rate, but then the terms with that bank or that institution is hard for you to move forward to your next one, your next construction. But then sometimes it can be the opposite. Sometimes you're trying too hard doing it with too many different banks. And then there's one bank that is totally in alignment with your goals and where you want to go. And that's the type of bank that you should be going with. And again, the only person that's going to be able to do that is your broker. They're going to help you out with that. So without further ado, I'll pass it over to you, Derek.
Thank you, Jason, and welcome everyone to today's session. Really looking forward to catching up with everyone and sharing some insights as to what's happening in the market at the moment. As we step into the new year, I think it's a perfect time to recalibrate your financial goals and your investment goals. There's been quite a lot of changes over the last few months, and 2025 is going to be another very interesting year. A lot of positive changes to come, and there's no better time to work with the right team, work with the right finance professional so that you're ready to take advantage of what the year will have to offer. Take stock of your current situation and be prepared for when there are shifts in the market. So today I'm going to give a quick update on the market, where the inflation is sitting at the moment, and how that is going to impact the property market itself. I'll also share what the outlooks of the major banks are sitting at, where they forecast rates will be going in the 2025 year, and also what does this mean for investors? If there are shifts in the market, if there are shifts in the interest rates, what does this mean for you as an investor, as a property developer, and how does that affect the overall market? And what is the best way to be prepared? What are some of the things that you can start doing now so that by the time there are shifts in the market, you can take advantage of it? I'll also touch on some updates within the lending landscape. As Jason mentioned earlier, it's crucial that a broker or the finance team has a strong pulse on what's happening with lending policy. If there are any shifts, slight shifts in policy, it could mean that you are able to increase your capacity or get into that development side or investment purchase that you previously weren't able to. So having a pulse on the market, constantly speaking to the BDMs, having them come into our offices and train all of our staff on a weekly basis, I think is really crucial. And that's what we really, really value, to stay on top of the market for our investors and for our clients. So just a bit of background about Final Advisory and myself. I've been working with Think Property, Jason and Amy, for a number of years now. I am a student. I have been part of their program for quite a long time and have worked with a lot of their students and have been able to help a lot of their students along their journey as well. So we specialize in helping investors grow their property portfolios, structure their loans the right way to allow them to get into the next deal and to help them get into their next development site, but also take them through the development financing journey with the various financing options. So we have a very good pulse on what the market is offering at the moment, depending on whether you're doing a single build, depending on whether you're doing a multi-unit development, depending on your specific financial circumstances. There are various lending options that we review just to make sure that you have the best options available to you. We have a team of brokers and buyer's agents, and all of our team are trained to understand what active property investment looks like, and they understand what an active property investor needs when it comes to structuring their loans and acquiring high performing property or looking at development sites as well. So we have a network of contacts all around Australia and constantly growing our team. And the team also includes credit managers, customer success managers, settlement officers. So we have a full team that supports our clients every step of the way. And we're not just a one-man band that will try and juggle too many things. We have specialists within their roles, and that's how we are able to build our team to support a lot of our clients. I myself, an active property investor and property developer, as I mentioned, working with Think Property for quite some time, have certainly been able to grow my property portfolio, get involved in subdivision projects, multi-unit projects, and also building rooming houses. And we, through my experiences and in my own projects and also helping a lot of the students in Think Property, I'm also able to understand what financing needs to look like with an investor hat on. So we're in the market and we are constantly getting involved in projects at different stages of the market. Okay, so when it comes to inflation, I'll keep it quite high level, but what we've seen is that over the last 4 or so months, inflation has remained within the RBA's target range of 2 to 3%. Now, this is a really good sign. Even though there are some slight fluctuations, it's a very good sign for where interest rates are headed. The RBA is now only meeting 8 times a year, no longer monthly, but there are a few economists predicting rates dropping as soon as February, with a few predictions of rate drops in mid-year, which I'll share a little bit more about when it comes to the major banks and their economists. The RBA is still very cautious to not decrease rates too quickly, because the last thing the market needs to see, the economy needs to see, is the rates having to go up again. So even though it's a good sign for the market, they are still very cautious. Another good indicator of where rates are going is looking globally. We've seen rate cuts happen globally in the US, the UK, US, Canada, New Zealand, Switzerland. So it's still a very, very good sign. So what are the major banks suggesting? I'll give you a bit of a rundown in terms of what the major banks have forecasted, all of the economists. So CBA expecting the first rate cuts along with ANZ in February 2025. And this also means that when it comes to further rate drops, by mid-2026, they're expecting up to 4 rate cuts by then. ANZ are a little bit more conservative and believe that there are only 2 further rate cuts by mid-2026. But overall, you can see most of the big banks are expecting around 4 rate cuts. Now, what does this mean for an investor or someone in the property market? If we were to consider 4 rate cuts of 25 basis points, that works out to be about 1%. Now, if you had $1 million loan or $1 million worth of debt, this would equate to a saving of $10,000 per year. $10,000 per year of surplus cash flow to allow you to invest or surplus cash flow to take out additional financing as well. This also means a reduction in your mortgage repayments, whether you're aggressively growing your portfolio or whether you're looking to reduce your repayments. This reduction will definitely mean a lot of shifts in the borrowing capacity. Now, for a standard income of, say, $100,000, a 1% reduction in interest rate would actually reduce your borrowing capacity, increase your borrowing capacity by about 5 to 10%. So outside of what we can do in terms of utilizing specific lending policy to increase your capacity, depending on the stage you're at in your investment, a simple rate cut of 1% would increase the borrowing capacity up to 10% across the board. And the higher levels of debt that you do have, whether it's investment debt or owner-occupied debt, this would be a greater than 10% increase in your borrowing capacity. It also means a very good opportunity to recalibrate your property portfolio. I mentioned before, being the new year, there are a lot of goals, financial, personal goals that you may have set for the year, but it's also a very good time to recalibrate your property portfolio. There are opportunities to not just increase your borrowing capacity, but extend your loan terms, reduce your monthly commitments, increase your cash flow, or potentially refinancing back to a major bank if you've really been pushing your portfolio, pushing your lending, considering second tier or third tier lenders. There are a few policy updates that have been implemented across multiple lenders, which I'll touch on in the later slides, which means that it would allow for refinancing to be much simpler, much easier. So if you have been utilizing a number of non-banks and second tier lenders to get into the next property, get into the next development, then there may be an opportunity to recalibrate, get back onto a lower rate, and then when rates drop again, then it's an opportunity to then go back into the market and take out additional lending. This also means with the reduction in interest rates and everyone across the board having their borrowing capacity increased, that there will be increased buying activity, depending on the market and depending what the investors are looking to do. So this means that as an investor that can foresee what's going to happen with the reduction in rates, is it a good time now to gain some financial clarity, to get set up so that you are well prepared when compared to the broader market? So as I mentioned, perfect time to review your financial position, especially if you haven't spoken to your bank, if you haven't spoken to your broker for a few months, for a couple years. there have been so many shifts that you may not be aware of that would change your situation completely. At the end of the day, you don't know what you don't know. And if you don't have a pulse on what's happening in the market, you might be thinking in your head, I can't borrow any more money. I've been told no. I've been told by another broker, a bank, that I can't borrow any more. But we've seen time and time again, having clients come to us that have been told no and pushed back, we are able to put our investor hat on and utilize our full suite of lending options to be able to help our clients get into the next step.
Can I also add to that, Derek? This is one thing when I first started my journey is I hadn't, to be honest with you, this is going right back to when I started, okay, or before I started. I hadn't done I was a private contractor, subcontractor, and I hadn't done my tax returns for 2 or 3 years. And so my lending was, pretty much non-existent. It was 60,000 maximum to buy a home type of thing. So it was really low. And then also I was taking massive tax cuts, like a travel allowance tax cut and all this type of stuff just to bring my tax down. All those things affected my ability to be able to lend money. Obviously, tax returns, number one. The taking $30,000 travel allowance, which is something that you can do legally, but it would bring my tax down from 90 down to 60, or even worse if it was a different situation. And then the last thing was that as father-son business, my dad wanted me to feel really good, so put me as director of all these companies. Now, he'd borrowed $5 million, was paying it back no problem to his financial institutions, but because I was the director there as well, when I went to go see the bank, the first bank for the lending, they turned around and said, you owe $5 million. And I was like, what do you mean I owe $5 million? I'd never heard of this. They said, oh, well, this is this company. I said, that's Dad's company. So because I was a director, I was liable just as much. In the end, did the tax returns. So this is what I want to talk about, and what I want to give people a hint on is that a broker can be really good at telling you how to prepare yourself in the future. So obviously straight away I was going to be no good. So they said, look, if you really want to do this, then you're going to have to structure yourself, maybe even going up to a year, to change your tax return so that you're actually on a higher tax bracket or a higher income level, to take your directorship off your dad's stuff, and then to get those tax returns just done and get it all ready, pay down your credit card debt as much as you can, focus on that. So in a year's time, bang, Jason, we can lend you $1 million. So all those type of hindsight things is, I think, really good advice, and where a broker can help you say, okay, well, I want to in the future do this and this. And then they can say, well, I'm glad you told me now. So in the next 6 months, we're going to do A, B, and C to give you in a better financial situation. Does that make sense?
And you raise a really good point there, Jason. I think as finance brokers, we work very closely with our clients and their accountants, right? The accountant's job is to save you as much tax as possible, if you're self-employed, that is. But we can work quite closely with them, and considering your goals in terms of property and acquisitions, we can work together with them and give them an idea of where your position may need to be, and lay down all of the options that are available, so they can make a judgment as to what's the best way to structure your returns. And not only that, outside of having your tax returns finalized as a self-employed individual, there are many other specific policies that will benefit you in terms of paying yourself a wage, in terms of lenders only looking at the most recent year's financials, only looking at your notice of assessment, right, and ignoring your financials. So depending on your situation, we look at it and we go, how can we solve this problem with our knowledge and our understanding of all the various policies out there? What is the best way we can help our client to ensure that they're not paying too much tax within reason, and then helping them get into their next portfolio as well? And in addition to that, getting prepared is the most important thing. And what I mean by that is, if our client has a goal, we would make sure that we don't just recommend a lender that's maybe easy for us. We go, okay, bring all of your lending with this particular lender and the next purchase, but then they're going to be stuck there. So we would put in the effort to make sure we would even stage the financing in a way, take advantage of the unique policies of one lender before we go to the next one, And that way we've really maximized our client's position, ensuring that they have the best rates, that they can do exactly what they wanted to do in terms of their property goals, and have a pathway to get back to a major bank. And
that would get back onto structures as well, which way to structure yourself, because I've had a lot of students, been over for a decade in this industry. You're probably close to a decade as well, if not over that. But I've seen people come to us and say, oh, I went to my broker and my broker said I can't do a trust company. I've got to do it under my own name. And I'm like, well, you can get loans under both type of structures on your own name. Or there is definitely going to be a trust company loan that you can definitely do. And then I said, go back and ask your broker. And they were like, oh, it's too hard to get a company trust type of structure to get a loan. It's a lot easier and a lot quicker for me just to put it all in your own name and get your parents to be guaranteed. And we can get you a lower interest rate, get you it straight away. And really all I'm hearing there is it's easier for the broker. Instead of thinking about, well, what are their goals? Because from asset protection and from that whole point of view, it's just simply better to put it in a trust structure for that particular circumstance. There are ways that you should put in your own name, a quick exit or a reno or something like that, but just a lot of brokers you'll hear say, no, you can't do company trust, forget about that. And it's just, they're basically just saying, in my opinion, and I'm not kind of having a battle at all the brokers out there, but in my opinion, it's just like, it's easy for us to just put in your own name. Don't make the paperwork hard for us. What can you say about that?
Yeah, it's quite interesting. There's a lot of brokers out there that would advertise they've got 30, 40 lenders on their panel, but you come to realize and you come to see that they only use the big four. And even within using the big four, you're already at a disadvantage. All the other lenders out there, some that top 5, top 6 lender, we're not saying use purely non-banks, but lenders that do favor trust lending, right? And they don't make it difficult. In fact, they benefit the investor to allow them to continue to grow with certain policies. If the broker does work with trusts and work with companies, that they're able to help their clients borrow more when they go to a different bank, and the bank will say, sorry, we don't do all trusts, or it's too hard, it's too complex, you've got to pay higher rates, or whatever that may be. The broker really needs to understand what the investor is looking to do and how they can be creative to allow them to move forward.
Yeah, great point. Thanks for clearing it up for us. That's great.
Okay, so back to getting prepared, a review of your situation. There's been a lot of shifts, as I mentioned before, in the property market. Where is your portfolio sitting at the moment? Do you have any equity that is sitting unused and you're not making a return on that equity? Has there been any growth? Have you continued to pay down the debt? Is there an opportunity to recycle your debt? I've read some data the other day that said that offset levels are at the highest levels, right? So because of what's happening in the market, that there are a lot of families, investors saving money in their offset accounts, right? Is there an opportunity to turn your own occupied debt, which is non-tax deductible, to tax deductible debt, which would not only improve your cash flow, but improve your tax deductibility position and also improve your borrowing capacity? As I mentioned before, borrowing capacity, it's been quite the topic over the last year or so, but is there an opportunity to not just take out more lending? When I say increase borrowing capacity, it also means improving your cash flow, improving your monthly commitments. You may have an existing home loan, whether it's investment or an own-occupied loan that you took out 10 years ago, 5 years ago, whatever the case may be. The minimum monthly commitment at that point in time would have been based on your initial loan amount. If your loan has since reduced because you've repaid the loan over the 5-year period, 10-year period, the loan has reduced, but your minimum monthly repayment is the same. If you were to take that loan, refinance it, not increase any lending at all, and extend the loan term back to 30 years, you've literally just reduced your minimum monthly commitment and improved your cash flow, meaning you don't have to pay that minimum higher payment. Doesn't mean you shouldn't, and doesn't mean you can't. You can still make the same repayment as you were before that you refinance and extended the loan term, but the minimum commitment has been significantly reduced. So that allows for much more flexibility. If you were to continue to maintain the same repayment you were making previously, you would still actually pay down the loan in the same amount of time. But reviewing your situation and giving yourself more flexibility, particularly in current times like this, just makes it a lot simpler and puts the pressure off. And if you are in a position where you're looking to grow your property portfolio, it makes much more sense to review your situation right now and be ready. What we can also do in terms of helping our clients prepare for what's coming up. If we review a situation and let's just say, for example, you really have maxed out your capacity, or we focus on, okay, let's get you into the next property in the next few months. Well, then what happens when rates do drop, right? If rates were to come down by 25 basis points or 50 basis points, what does that look like in terms of my monthly commitments? What does it look like in terms of my future lending? So when we strategize with clients, we can work out various scenarios, and that's really the experience and where we specialize in being able to help our clients strategize and review different scenarios to help them further. There were tax cuts in June, particularly if you are an employee. The tax cuts earlier last year or mid last year also meant that your borrowing capacity situation would have improved. And another good opportunity to take advantage of everything that I've just mentioned, along with the policy updates. So I'll touch on a few updates to give you an idea of what the lenders are doing. And we're seeing, over the last year or two, policy continue to improve for individuals, whether they're PAYG or self-employed. The banks are really still wanting to lend. We've seen cash out limits increase. So when I say cash out, I mean utilizing your equity in your property to be able to further invest. There are banks that were previously limited to cash out limits of 100,000 or 200,000, and you have to provide all the documentation, a contract of sale, an invoice to prove what you're utilizing the funds for. Right now, we're seeing many banks increase that limit to up to $1 million or even more, depending on the lender, with a great explanation and without having to provide documentation and evidence and even controlling the funds. So some will allow you to cash out the funds, but when it comes to settlement time, they will only pay into the solicitor's trust account if it's a property purchase. So all of those restrictions have softened, and we're seeing more and more lenders increase the ability to cash out additional funds. Another good sign with where interest rates are going, we're seeing fixed interest rates come down. Right now, we're seeing variable rates sitting at low sixes or just under 6, but 2 to 3 year fixed rates starting from 5.59%. So a lot of the economists and the banks have already priced in where the market is going. And if you want that extra certainty, you can also consider a fixed rate or consider a fixed and variable rate split. But that's also a good sign for where the market is headed. 16 lenders now offering a 1% buffer policy. Now, this 1% buffer policy is relating to the buffer rate that lenders add on top of the advertised interest rate. So say, for example, if the interest rate is 6%, when a lender works out your ability to borrow and how much you can borrow, they will add a buffer rate of 3%. This buffer rate is to protect you, to protect the lender in the event that rates go up. You can still afford your loan and not be put in a position where you can't make your repayments. Now, initially, earlier in 2024, only the big four banks offered this 1% buffer policy. And what this meant was it allowed for anyone that was stuck on a high interest rate to refinance their loan, assessing them on a 1% buffer rate instead of a 3% buffer rate, because a lot of people were stuck on high rates, but they couldn't refinance to a lower rate because they didn't service due to the rate rises. So this new policy, this 1% buffer policy, meant that anyone that had an existing loan for 12 months or more and their new repayment was going to be lower than their old repayment, the banks would reduce that buffer rate down so that you can actually save money. Now, currently 2025, we have seen 16 lenders now offering this 1% buffer. So even if you're not extending, improving your borrowing capacity and taking additional lending, it is a good time to recalibrate. If you're being told, if your income situation has changed over time, and at that point you weren't able to go into a lower rate, now might be the right time for you to review your situation because of all the policy changes out there.
So how does that happen with your company when I've got all my loans existing and I want to review? Can you do that for me? And then how do you go about finding out whether that rate's going to be better than what I'm on currently? And some people think, do the banks get notified of you looking into this or something like that? Or how does that work to kind of let people know that process of refinancing?
Yeah, so the first step, of course, is really understanding our clients' goals, where they're looking to go. Having that knowledge and having that understanding, our credit team will then collect all the information that we need and complete the assessment based on the client's objective. Now, anything that we do is in the background. We have access to the credit rate, the credit scores, and all of your credit inquiries, but nothing we do will make an inquiry with with your existing bank, unless we actually move forward in contacting them or putting in a new application, but nothing without you being fully aware of it. So we take all the information, we do a review of where you're at, give you some clarity, and we point out, our team are fully trained to point out the opportunities that we see. Whether or not you decide to move forward with them, if we understand your objective, we will point out, hey, there's an opportunity that you can pull out some equity here. If we were to move this property to this particular lender, you would reduce your interest rate and also have the ability to cash out funds for the next investment. Or if you are working on a development deal or property, staging the finance to ensure that the inquiries that you make don't impact other applications is also quite important. So, strategizing and staging the financing is something that we do really, really well.
Do you ever do those other things too? Going a bit off the mark here, but I've got some questions coming up from people that I always kind of see. If someone does have other debts, like credit card debts and that type of stuff, you know how sometimes people are able to work out a structure where they can pay them off or incorporate them into a loan. Why I bring it up is, again, another story from when Amy and I started out. Our broker sat down with us. You weren't around at that time because this is going back quite a long time now, like almost 15 years. But they saw that we had 2 or 3 properties. We had some equity in them. And then they looked at the situation, said, well, how can we, what can we do for these guys? Because they actually are in a situation where they've got a home loan and then they've got a car loan. And the car loan was 15%. And the broker came up with this great thing to save us so much money on the car loan, where we could just take it out against the home loan. So take out some equity from the home loan, pay down, and those rates were like 5% in those days. And instead of paying 15%, something so smart like that. What do you reckon?
Yeah, debt consolidation is a big one. Is another opportunity that we look for and something we always point out. If you have any existing car loans or personal loans, you're generally seeing rates 10%, 15%. If you have any credit card debt, we do come across clients that may have multiple credit cards that are maxed out and they're paying 15 or 20%. and they don't realize that they could leverage off their existing equity, which is, you know, a 3-4 times lower rate, in order to consolidate that debt into the home loan. And that actually just clears their position completely, and the interest that they would have been paying, they will be saving significantly. In addition to that as well, you know, car loans and personal loans typically over 3, 5, or 7 years. So if you've got a $50,000 or $100,000 loan, your minimum monthly repayment is going to be much higher for a shorter loan term. If we were to consolidate that debt into the home loan over 30 years, that would reduce your monthly commitment as well. And not only does it save you interest, but being mindful that if you were to make the same repayments, you would pay off that loan within the same amount of time, and likely quicker, because you're saving on interest rates as well. So consolidating debt is definitely something we focus on as well. Another important thing to note around any self-employed individuals is that we're now in 2025. A number of banks have already, as of the 31st of December 24, started saying we will now require your FY24 financials to consider the income. So this means that if you had a really good year in 23, not so good year in 24, if depending on the bank you are approaching, they may require you to have your FY24 financials finalized. But it's a good time right now to consider reviewing the situation and look at your lending situation, because some banks already cut off in 31st of December. We've got a few more banks with a cutoff in March, and then just a handful in May. So you've got a little bit more time to make a decision and review your situation. But if you really did have a strong year and you wanted to consider your next purchase, then it may be a very good time to get in before the banks cut off the requirement for the financials. And as I mentioned before, there's a lot of simplified policy out there at the moment for anyone that is self-employed. Having that knowledge, we can review your situation and give you some ideas around what you can do about your situation. So that's it from me. You can reach us at financialadvisory.com.au, or our email is there. We are a team of finance brokers and buyers agents operating all around Australia. We'll be more than happy to have a chat with you and review your situation and get you set up for the rest of the year. If you scan this barcode, you can schedule in a time, fill in some information, and we'll offer a free strategy and review and plotting of various scenarios to help you along your journey.
Yeah. Now, just explain to everyone, just because you're in Melbourne doesn't mean you can't do finance all over Australia, right? This is where people sometimes think you need local. I don't see any advantage to having someone in your own town or not. I see more advantage to having someone with more PTR, proven track record, right?
That's right. We support clients nationally. We've got clients doing projects all around Australia. We're not locked in Melbourne. Essentially, even our buyers agents and all of our networks do operate nationally as well with all of our contacts. So there's no restrictions stopping us from buying or financing in the various states. So more than happy to assist anyone all around Australia. We also do a lot of work with expats, Australian expats living in Singapore, living in the UK, living overseas. There are very specific lending policy out there for any expats, but non-residents and foreign lending we also do as well. So we're not even locked within Australia. We've got clients all around the world.
Yeah, you like Singapore as well?
That's right.
So Derek is actually branching out in the future. So we will have a lot of those type of things. And who knows, maybe you're bringing us some finance from overseas as well.
That may be the case.
We'll give you a task to go and do those type of things. Now, the other thing, Derek, I think this is one of the things that worries people the most in the property world, and advancing, getting multiple properties and those type of things, the whole lending thing. And it can be quite daunting on people just to get past that, and quite daunting to say, I'm going to spend money to get a $2 million construction loan or something like that. And there has to be a way to look at it and to change your mindset to be more of a business outcome, to be able to say, okay, let's be sensible about this. Where is this money going? What's repayment? Why am I doing it? And what will be the outcome of it? Because this is where I see people kind of get a bit stuck to even go a little bit bigger, maybe to do a duplex or do something else. That there is this worry whenever you hit over like the $1 million mark or something like that, that it kind of creeps in. Now, you've been around for a long time. You've got your own loans. You've got your own developments going on. Can you give us a bit of a hindsight into the Derek Wong journey of getting that mindset around money and loans and even doing construction and that type of stuff? What's been your experience with that, and how have you helped out people that kind of are worrying about that whole loan issue and money and finance and bad debt and good debt and all that?
Yeah, I think it falls back to your money psychology, and I think when you're starting out, we're all taught the Australian dream is to buy a home and pay down the loan as soon as possible, and retire. But we're seeing a lot of clients that approaching their retirement age, that strategy doesn't really work. That doesn't really set them up. And what I've personally become much more comfortable with is leveraging off good debt, right? Leveraging off debt at 6.5% interest rate, so that I can invest that money and make a 20% return, 25% return, 30% return, depending on the project that you're looking at. So, it's just a slight shift in understanding, instead of saving 6% and putting money into my offset account, I should use that money to make even more money, right? And what we all know what the banks do with the funds that are sitting in the offset account. They make their money, they've got their day traders making 1% to 2% every day on the money that you're putting into your offset account. So they sell this dream. It's great to have an offset account and pay down your loan, but they're actually making more money, 1% to 2% a day, versus saving 6% over the year. So personally, my mindset has shifted around being comfortable with good debt. And of course, it's important that you get the right education, you get the right mentors, that you focus on ensuring that you educate yourself in all of your decisions. And what we do as finance and property specialists is we have seen where investors go. We've seen great outcomes, and we also ensure that we help our clients understand what are the risks, and if this were to happen, what's plan B, what's plan C, what are the various financing options that we can support our clients with? Because a lot of investors, wanting to get good deals and make offers and unconditional offers, we like to ensure we educate our clients to make sure they understand, what an unconditional offer means, but we make them feel comfortable with the options that we have available to them. It's not just, sorry, lender, it's not working with this lender, figure it out yourself. No, we make sure we make our clients feel really comfortable. They have all the options laid out in front of them so that they are set up for success.
Great. That's good. So where is your headset now, Derek Wong, into what you know about finance? And will you keep doing developments? Will you keep buying properties, or are you paying down? Or, what age are you at the moment, Derek?
I'm 33 at the moment.
33. When did you start getting into the property journey? As in, let's say education first, and then buying your first property and that type of thing.
I first got into property when I was about 22 years old. In my last year or second last year of university as a civil engineer, I went to my first property event, and it opened up my eyes. And from that point, I just focused on educating myself. My mindset and psychology around money and my career completely shifted, and I focused on educating myself getting the right mentors and having the right people around me to ensure that I can make the right educated decisions. And the first property that I did purchase was a 5 townhouse site development. And I went through the whole process, through all of my learnings to engage the right professionals, engage the right consultants, and get approval for the townhouses. So it began at a younger age, and it was really my way of leaving my engineering career, and I came across finance where I was able to share my knowledge and experience over the years, and also help others build their property portfolio and help them along their journey to achieving financial freedom. And that's really why I got into the business. And that's our goal, to help Australians along their journey to achieve financial freedom through all of our specialists, through our team, our property specialists, and we are aiming to grow a presence in every state.
And personally, what do you look at now? Are you looking at profit or cash flow? I mean, I think you're pretty much balanced on both now, aren't you, with the experience that we've been involved with you in doing things, and where you look at opportunities and that. I think when you're younger, it is a lot about profit. You just want to get as much money in that bank account, and that was us too. And then as you get a little bit older, you start thinking, hey, I've now got the ability, maybe I can do something in the cash flow so that I'm actually getting a higher rent return as well. So was that your journey at the moment, or where have you been? Or have you seen other opportunities? Are you looking, where's your mindset now? Do you see opportunities overseas, or do you see opportunities in other markets, or?
When it comes to investing, my focus is still in Australia. That's where, even though I have plans to expand internationally, I certainly do want to eventually come back here and retire here. So right now, my focus is on growth and scaling. So I'm comfortable within reason to leverage off good debt to grow my property portfolio. And over the years, I've really diversified, getting into rooming houses, really high cash flow type properties, which also allow you, based on certain financing strategies, to continue lending. So it's a combination of seeing the opportunities in the market at the moment. Development funding and development and construction have slowed significantly, and I think that there is a really good opportunity to acquire sites. So I'm back on the market looking for development sites, and have the opportunity to even convert those properties into rooming houses, which is something that I've done and have a business in as well, converting properties into rooming houses to increase the cash flow, to allow me to hold the properties, and then when it's the right time to do the developments, I can then make a chunk profit. But what I've seen is, rooming houses to be the flavor of the year, and great investments, great for self-managed super funds, great for anyone at the stage where they're focused on improving their cash flow position rather than making chunks of profit.
Yeah, I feel that too. I feel that our journey has been where we're helping a lot of clients out and our students not only just get into the rooming house scenario, but also find the right location. I mean, you'd know how important now, because you've studied with us privately as well, about location is so important. And it doesn't mean about a hotspot. It means about doing our method that we teach you in our course, to say this is the targeting method. If you have these targets within your proximity of where you're looking, and you're looking off PTR, and you've got the right team to advise you whether this location all stacks up, and even being around areas of more significant zoning policies, even being in councils which are pro-development, is so important to when you look back at your portfolio and you go, actually, I know I can even grow this portfolio in the future if I want to. And I think, I mean, I know a lot of because we've been involved so much mentally together, that where your locations are and where you've invested in that, and it's following the same pattern. The pattern that we teach is something that you've taken on board and said, look, just because someone has an opportunity for me, or some newspaper says a hotspot, that's got nothing to do with really where I'm actually sensible as a developer moving in the future about where I should be putting, where I should be buying. And do you still, just talk to us a little bit about the pattern of investing and how that's changed where you've actually gone from knowledge of before about just real estate and then the knowledge about, hey, where the targets are and developing opportunities.
Yeah, and there's certainly so much to the due diligence piece and finding the right site. There are markets within markets, and with the right knowledge, you're really able to dive into a particular area, look at a particular site, and understand. As you mentioned, PTR. What's happening around in that suburb? Are there developments happening already? If you're looking at an area and there are no building approvals, there are no applications with council, then you need to rethink your strategy. So certainly the focus on knowledge and training, making sure you're well equipped, utilizing all of the software and tools out there. We use some pretty high-end software now to help our clients, which makes it a lot easier for us to be able to find the right information at the click of a button, and also look at data and metrics, projected data, and also past data as well. So we really get into the nitty-gritty of the numbers and the metrics, and as an investor, all those tools are available to you as well. So as you continue along your journey and you get the right education in terms of understanding what is the right property, what is the right area, is it on the right street, is it an area that I can actually manufacture any growth in, is extremely important. And with our clients, when we understand their objectives, we say, great, this is what you're looking to do. This is how you can structure it. We have our own proven track record with lenders, right? We know their unique policies specific to that lender will benefit our client situation there. And we will make sure that we recommend those lenders to our clients.
Great. Thanks for sharing that with us and being so open. It's really important that people look at our professionals that are working within our team and look at their experiences and get a bit of trust from that also. I mean, you're not just a broker, you're a student, you're a property developer, and you've been a very good mentor for our students as well. They need to see a mentor in their broker as well. Someone that can be honest with them, someone that's not thinking about, okay, well, how am I going to put in the easiest loan, giving them options, but also turning around and having a bit of a hard talk with them and say, we need these particular documents at this particular time, and we need you to be able to get this tax return and get this summary done, because it's just so crucial for us to be able to service you the best. And I think that's very important too when you're working with a broker. Timeframes are important too. If you need money quickly or you want them to assess it quickly, then really start taking notes of exactly what will help them be able to get you the best type of loan. And it's very, very critical too that you kind of get prepared before you go into any meeting to say, go and find out where your properties are, go and find out your interest rates, go and find out your repayments, go and find out the terms of your loan, go and find out the names of their trust structures, how are they bought, what type of titles are they in. Even a spreadsheet would be great, because I know that when I started out and when I'm still talking to my broker today, I'm giving them all those details just on a spreadsheet. So it makes it nice and easy for them to just convey over and have a look at it there, and make sure that they're just now concentrating on, okay, this is your scenario, this is where you're at, where you're going in the future. I think also being honest with them about your personal scenario too, about what are your commitments? What are your loan? What's your spending habits like? What is your relationship like? Are you verging on maybe a divorce one day? Is everything going okay? Have you had bankruptcy before? What about your own private business? How much loans does that business have? Who are they with? All these type of factors build a beautiful story together. And even your broker could turn that into a scenario that helps out the whole above board. And then also looking at your super, and then talking to your broker too, and being really giving them the full story, because everyone has a different scenario. And then by also saying, okay, these are the things that are going to happen in my future as well. I will need to do this in the future. I'll need to do that in the future. This is our family home. We are looking at maybe selling it or moving on, or I might need to help my son go to university, or I might need to help my daughter buy a car or buy a house in the future. Like lay out that whole story for them so they can move forward with that. Now, if you've got any questions, this is where you can actually put that in the comments now. Just write the question in there, or if you want to just come on the mic and have a one-on-one, that's your opportunity to do that too. Lawrence has come to hear about an accountant in eastern suburbs of Melbourne. The only thing I say is always look at the accountants that we've got on board, because again, like we just heard here, the accountant, especially if they're structuring you up to get a loan and tax returns, would be a lot better to have someone that's looking at you from a point of view of not just getting tax returns done as quickly as possible, but how will those tax returns affect your borrowing capacity in the future? It's exactly the scenario I was in. I was with the wrong accountant that was trying to save me so much tax that it brought down my income level way below what I was actually earning. And therefore, the banks only took that into account. The banks only take into account your taxable income. Remember what I said before? I was 90,000, $30,000 was my tax-free threshold, because it was a travel allowance because I was from Newcastle to Sydney, and I claimed it. It was called the politician's travel allowance, where they could claim it as well for traveling between Parliament and back and that. And this was just something legal, but the problem was that accountant just wanted to try to save me the most amount of tax. And so then when I went to Wisdom and started using them, they said, okay, well, do you mind if a couple of years we just don't take that? And then you better borrowing capacity from 60 to 90. So if you're on 90,000 instead of taking that, and then in the future we can maybe put it back. So yeah, it comes down to looking at that accountant that you're working with, that the solicitor that you're working with, the broker that you're working with. It's not only who they are, anyone can suggest them, but what type of experience have they had, which is why within our program, we always try to give you at least one specialist in the field that we've used or that we know has got good PTR reputation to be able to help you make the best decision within your longevity of where you're going to have your process go to next. So I think that's really important. Any more questions here? I don't see any questions here so far, other than the accountant one, which is fine. Can you advise as to how I can use my super to invest in property? Now, again, what's the first thing you've got to say when we get this question, Derek?
You definitely need to get the right advice. Speak to the right professionals, a financial planner, and your accountant as well. There's definitely many opportunities.
So legally, what I'm alluding to here is when the word self-managed super fund comes up, we need to legally say, as mentors or anything, we are not a self-managed super fund advisor legally, and we're not giving you advice on self-managed super fund. Now, because that's just the law. And I don't know if Derek has got his license as self-managed super fund or not, the legal advice and that, but for some reason they have put in certain people there to be that, which is a good thing too. But yeah, so when it comes to investing in property in your super, it can be done and you can set up loan structures, but there has to be a person involved in there, which is a self-managed super fund advisor. Is that right, Derek?
That's correct. I'm not a licensed financial planner and would always refer you to the right professionals that would be able to have the conversation with you, and they may or may not recommend a self-managed super fund. It really depends on your unique situation and circumstances. Can you invest in your super? Yes, but you need to get the right advice from the right professionals.
Yeah, and then a loan can happen out of that, and that can be organised.
That's right.
There's this mandate of we have to keep saying it. I'm not even probably allowed to even say the word without having that advice to there. It can be done. It's different. It's not as easy, but it definitely can be done. But don't think what I have to say, what I know from experience, in which the self-managed super fund advisor would tell you, is that you can't change a property. So you can't develop a property, use your self-managed super fund for development. It's more about, okay, maybe you could switch from ones into self-managed super funds, or could you buy something, or commercial, or all these type of different ways structures, or could you lend with your self-managed super fund? So that's something that they can advise you on, and then you can come back to us and do that the right way. So Tim said, my current accountant, I'm telling them what they should be claiming instead of them suggesting to me what is good. Unfortunately, they seem to get excited picking up dollars and cents, but miss out the thousands of deductions. So Tim, again, deductions can sometimes harm you from my experience, and I've seen it happen too many times. So we need to be saying, well, what is our income that we need to be on to be able to, how much can we borrow with this income? How much can we borrow with that income? Now, especially the accountant that we use for our private finance is the same one that we use for our portfolio, because we want to be able to know, well, how should we be structuring everything in alignment with how much do we need to pay ourselves, how much are we borrowing, and then our properties, what is the negatives and positives of our properties, and what are they doing for us as well. So again, just having an accountant in this property game that we talk about, that we dwell in, is very good. Will definitely help you out, and I'm sure Derek can back me up on that again. So any suggestions for brokers and agents in Perth? Well, again, so Derek, have you ever done anything in WA?
Definitely. We do a lot in WA and have a lot of clients in WA. So we're not restricted in terms of the state and where we're based. After COVID, everyone's much more comfortable meeting over Zoom. All of the information we collect and present works really well over Zoom. And we've got even clients in Melbourne preferring to meet over Zoom. So certainly not locked by state.
Great. Good. Okay, let's see if any more questions come up in the next minute. Other than that, I think the other tip that I want to give people is when you are going through and making that final payment to the solicitor or whoever's doing the conveyancing and that type of thing, the banks have started getting you to call them and check the actual account number that you're transferring, maybe your 500,000 for a block of land that you bought. Because there has been situations of scammers getting into people's private emails, seeing that you're emailing to about to do a transaction, then pretending to be the person that you're transferring it to, whether it be a solicitor or a conveyancer company or even the agent or the owner, whoever, and giving you a different number to transfer it in. So when you walk in the bank and you do that and you've been scanned with the wrong account number, then that money is lost. It's gone. So the little tip, and Derek, I don't know if you're onto this as well, you probably would be being in the game, is that when you go into that bank, you need to be finding the number that you originally started with whoever you're transferring it to, whether it's a solicitor or a conveyancer or whoever it is, and asking them, let me double check this account number. Because there've been some crazy stories where people losing millions and millions, and even very, very smart people, like people with mega businesses doing this. So now the bank actually, when we went and did it last time, they said to us, can you check the this person that you're about to put the money into the account? And we're like, well, we've done this 4 times and the account number hasn't changed. So it looks like the same thing. But it was just nice to see, and that was NAB. Getting in the mist there and saying, hey, just wait before you actually make this payment. Please, we will not let you do it unless you call them physically on the phone and double check this number. What do you reckon about that, Derek?
Yeah, certainly scammers are getting more and more creative, getting access to solicitors and conveyancers and their emails and sending you the information. So it pays to give them a call, speak to them over Zoom, know what they sound like, what they look like, and that way you can double check all the numbers and make sure if you're transferring large sums of money, it's going to the right place.
Yeah, maybe we should get them to hold up a piece of paper with their face. I don't know, anything can be AI these days. So it is important, though. I don't know a full fail-safe with it, because they can fake the voice, they can fake the photo, they can do the whole thing there. I suppose the only face-to-face would be good. Let me write down that number, the account number, and then go through. Maybe that's your only way of the future. But of course, going through and just double checking that that account number is important. Is important as you go along. One of the things there. So thank you, guys. Thank you, Derek. I really appreciate you coming on and spending time with us and everything you do for us, and the way that you've helped our journey grow, because I mean, Think Property Club is only as good as the people that support it and the people in Think Property Club like yourself. I've had, great reputation and great feedback from the services that you've supplied our clients as well, not just us. And that feels really good to know that I can actually have someone there, not only with background, but there's a certain type of way. I'm not trying to give you a big head in anything, but I'm just trying to point out, do give good broker, bad broker, right? There's a certain way that you operate, Derek, as well. And in being able to be very plain to the fact and not have to, some guys waffle on about this and this story and that story and kind of do the whole ego thing and everything and get into it in a bit. And that can kind of lead away from the true reason why you're there. And the true reason why you're there is, let's get everything done right. Let's make sure the right numbers are done. Let's make sure everything is crossed. Let's make sure that your future is intact. Let's make sure that we give you options for loans. Let's make sure that the meetings are on time. Let's make sure that we make sure that we communicate before the settlement process goes through. Make sure that we're giving you the honest advice and not kind of leading you up to a situation in the end going, actually, now you're going to have to get a security against that, or now you're going to have to do this at last minute. And that's all the feedback that I've got from you, all those type of different steps and processes, which people have enjoyed that process. And getting money with a broker should be an enjoyable experience. It shouldn't be a drama. And now there's always going to be different cogs and wheels in the process, right? Banks are not always going to have that money exactly on settlement date. There's going to be situations that things will get lost in the process. And we know this, Derek, but you never fret about these things. You've always got a solution to it. You've always saying, okay, and by the way, let's get this done a bit earlier, or let's have this conversation now because these things could happen. So let's make sure that we get it done. Or when a bank does lose some documents or something goes wrong, or even from the point of view of, we can't get finance because something's coming up on your credit rating. No matter what it is, we need to fix that first. We just need to really go through and do that, because it won't just be the finance of us, it'll be going on in the future. So let's go back and fix that first in your best interest to help you get ahead. And that's been really good. I think that's very important. Any other last bits of advice?
Yeah, look, we love what we do, and we really focus on the outcomes our clients are looking to achieve, and we focus on the solution. We're not focused on the rate or the bank, or focused on what our business goals are. We're focused on the client and very client centric, because we love the outcomes and we love to see the results that the students are getting. So that's why we've structured the team in a way that would help the clients along their journey every step of the way, so that they're not left in the dark. They know exactly what's coming up next. And like you said before, your situation right now may not be primed to take out lending, or you may need to do a bit of homework, do some work in the background to get yourself to that level, to that point. And that's what we focus on. We focus on, okay, well, this is the situation right now. These are the options. This is what you can do. These are the plan B, plan C options as well. We like to make sure our clients have all of the information to make the educated decisions and investment decisions.
Yeah. Now, one of the last questions I had here is this a good time to go for refinance at the beginning of the year? Will they be giving good deals, or is it for the financial year where banks kind of give good deals? What do you reckon?
When it comes to refinancing and getting on top of your portfolio, your situation, it's the best time is right now, right? If there are any rates drops and reductions in the future, if you're on a variable rate, you will get to take advantage of those rate drops as well. But if you refinance now, it doesn't mean you can't refinance in the near future. There's no reason why you shouldn't be saving money now, getting yourself prepared so that you can get into the next deal. There's never a better time to get prepared than right now.
And is there a habit at the new year that the BDMs and all get told, okay, go and get some more business, or change your structures, or let's do a special New Year's discount to try to get more people in? Does that happen with banks? I don't know.
No, the banks have their own agenda. They may look to reduce or increase rates based on where their business is at. So our job as a broker is to negotiate on your behalf, right? At any point. If we go to one specific lender because it works out for your situation and provides you with a solution, we also say to them, hey, this other bank is offering this rate. We're more than happy to bring you business, but can you beat that rate? And we do that with every lender, right? So it doesn't really matter, what one bank is offering over another. We will do our best to pit them against each other every single loan, and not just, okay, well, it's easy to just place the application with this lender and not do all the extra legwork. We have built our team specifically to be fully resourced to be able to help our clients get the best deals as well.
Great advice. Thank you, guys. Thanks for everyone for coming on. That'll be the end of the webinar for today. I hope you enjoyed it. At any time, you can reach out. Derek's always on our website too. You can listen to his advice and go through in our specialist section on our website if you're in the course, and you will actually be able to hear Derek on stage talk about the whole process of lending and everything as well. And it's really good to be able to do that. And always, you've got to be seeing this process as it's not about how much you can borrow, it's about the team that you have that can get you access to the funds. You don't have to worry about this or that or situations. Let them do the work for you. Let them tell you what type of capacity you've got. Let them worry about that scenario. Don't go, limit yourself. You never know what might happen. Or if you're in a scenario, they might say, well, this is your maximum. You need to go find another person with this much equity, or you need to find someone else's JV partner who can service this much debt or can get a loan for this much. So they can help you within that process as well. So yeah, it's worth reaching out to them. Thank you, guys. See you later, everyone.
Thanks,
Bye.
everyone. Thanks, Jason.